Let's talk mortgage loan structures for 2023. Now, realistically, it doesn't actually matter if it's 2023 when you're watching this or 10 years later, because these three examples that I'm about to show you are going to apply regardless. Now, each example I'm going to do pros and cons, and you might find one that maybe your situation identifies with more than others. The key thing to remember is that this is not individual financial advice, because I have no idea what your situation is. I'm just going to give you three examples. Now I've got my laptop here to run you through these examples with the numbers, and this to explain revolving credits properly. A revolving credit is the same or very similar to an offset account, and it can help you save years off your mortgage if you use it properly. But the problem is most people do not understand what it is, and hopefully my trusty utensils, you'll understand it a little bit more. So in every example, there's going to be a $900,000 loan amount. Okay? And I'm going to break that up and show you the pros and cons and what the costs per month would be depending on the loan structures that I pick. Okay, so let's start with option one, but all this stuff here, where your interest rates are, that's going to stay the same for all three examples. So you've got a $900,000 mortgage, probably because you bought $1 million property and put $100,000 in. Option number one is you put the full amount on 1 year fixed, or the full amount on 2 year fixed. Basically, you just fix the full amount. Now, this might be tempting because of whatever the interest rates are at that time, but this is probably the most risky option out of all of the options, because what happened 18 months ago is people all locked in for 2.2% for 1 year, and then they had to basically be exposed a year later to really high interest rates, and that meant their quality of life changed drastically. So although you might be tempted by a lower interest rate, this is the most risky way of doing things, because in a year's time, your whole mortgage is exposed to whatever the rates are at that time. Now, this is good though if you just want consistency for 1 year. You don't have to worry about anything. It's fixed for a year, and then obviously after that year's up, you just fix for another year, and that might suit you. However, there are less risky options and potentially cheaper options. So if you went with this one, it was $5,512 per month. Remember that number. Option number two is you break up this $900,000 into three $300,000 portions. Now, realistically, you can actually break up your mortgage into as many portions as you like. You can do floating portions, you can do fixed portions, you can basically do it as many portions as you like. Now I'm just going to set all of these the same. Of course, because they're in three different portions, they're going to be fixed on three different durations, and each duration is going to have a different attached interest rate. And this process that I'm doing right now is called interest rate averaging. So you've got 300, 300, 300, a year, a year, a year, 6.2, 6.4, 5.99. So that means that in total, your mortgage is going to cost $5,511. So not that much different from option two. The good thing about this is in a year's time, only 1/3 of your mortgage is coming off. So if interest rates are super high, you're still going to have lower ones to keep down the average. So it's softening the blow. But if interest rates are lower, at least 1/3 of your mortgage is coming off to bring down the cost. And then obviously a year later and the year after that. Now, of course, you could have just fixed everything for 3 years at 5.99 like in option one, but then you'd have to wait a full 3 years to make the most of any interest rate drops. Whereas with this one, you can make the most at year one and year two. So it kind of covers both bases. Isn't necessarily the cheapest option, because you have higher interest rates in there, but it doesn't really make too much of a difference. All right, and option number three, the revolving credit one. Now, I've put this in here already. If you don't understand revolving credits, don't worry, I'm about to explain those with my handy utensils, but I just wanted to show you on here what that looks like. So you got $100,000 of the $900,000 put up as a revolving credit. You've got the other 800 split into half. So you can split this other part into whatever you like. You could do option two where you split it into thirds and have a revolving credit, whatever. The key thing is understanding the principle behind revolving credits and then understanding what amount you should send it to. This is good if you've got lots of spare money or if you get paid commissions or you're expecting money to come in. If you don't have spare cash, probably not the best idea because of the interest rate you're going to get charged. If you do have spare cash and you can offset the interest rate, then that is where the magic happens. Because, for example, if you had $100,000 offsetting this 100%, you would not be paying any of this interest rate of 769. So although you can see up here it's more expensive than the other two options, if you were offsetting this 100%, it'd be closer to $5,000. Now let me explain that revolving credit concept a little bit more. So just establish that you're going to have 100K on a revolving credit. This is going to represent that 100K. So if it's empty, that means you got no money in there. You owe the bank $100,000, which is how most offset or revolving credit accounts start. And what your goal would be is if you've got that leftover cash or you've just got cash coming in from somewhere, is to put that into this revolving credit account. Right now, because it's got nothing in there, you're going to pay the full amount of interest charged on this 100K revolving credit, which we found in that example to be $769 per month. Now that's obviously a higher interest rate at the 8.5, so you don't want to do this. Your goal is to put your money in here to have it as much offset as possible. So if I did 500 mils, which is approximately half full, then you're going to pay half of that 769 in interest. And the goal is to get it all the way to the top. Because if you have it 100% with this 100K mark, that means you're paying zero interest because it's 100% offset. Your goal is to have it as high as possible. And the cool thing about this and an offset account, revolving credit, means you can still use it for spending if you wanted to buy a car or pay off a loan or go on holiday. And you obviously use that, drink it or whatever. But then maybe when you get paid again, you top it up. So the goal is to have the amount of money in there, you get paid again, so that you're offsetting your mortgage by the biggest proportion as possible. Now to take this a step further, some people will get their pay put into here, they'll use credit cards for all of their expenses, and then as the credit cards are just before they charge interest on them, or you get charged interest on your credit cards, they'll use revolving credit to pay off the credit cards and then start the process again. Pay goes in, pay off the credit cards. And the reason for that is because interest is calculated daily but charged monthly. Now I know this is more complex and more admin heavy than some of those other two options, but this one's for you because you think that you're going to save more money, and this one's for you.